Hey, what's up guys? It's Jonathan here. On Tuesday, we had a really mixed market with tech and high valuation stocks down significantly and with value and recovery stocks up for the day. And this trading action that we saw in the market on Tuesday might be a big indicator of what we're going to see moving forward. So in this video, we're going to discuss why these two separate groups of stocks traded in opposite directions. And we'll also discuss how to play it as well. So if this video provides you any value, please consider hitting the like and subscribe button. I just recently looked at my analytics and about 85% of you guys are not subscribed to the channel. So if this video provides you any value, please consider hitting the subscribe button and notification bell so you get notified every time I post a new video. And let's get right into it. So for us to figure out what happened on Tuesday in the markets, we're gonna have to go all the way back to the start of the pandemic. Back in March of 2020, the Federal Reserve cut interest rates to zero, and they also immediately bought $1.5 trillion worth of US Treasury bonds. They also developed a plan to buy $120 billion of treasuries and mortgage-backed securities throughout the duration of the pandemic. This was done to make sure that credit markets had enough liquidity to make it through the pandemic, so we didn't have a 2008 style recession on our hands. So fast forward to just last month at the FOMC meeting in December, when the Fed came out and said that they plan on doubling the speed of their taper of purchases of mortgage-backed securities and bonds. This plan had them on track to completely stop the $120 billion of bonds and mortgage-backed securities purchases by the beginning of March. Also from the notes of that meeting, it's expected that the Fed would raise federal funds rates 3 times in 2022. After they completely finished their purchases of bonds and mortgage-backed securities. Even though the Federal Reserve believes that they're going to hike the federal funds rates 3 times in 2022, the market doesn't believe that they'll be able to do that without some sort of significant downwards pressure on the entire economy. And looking at the Fed's fund rates futures, the market only expects there to be 2 rate hikes in 2022, instead of the 3 implied in the FOMC meeting notes. Pretty much what the Fed's fund future is, it pretty much gives them a way to speculate on what Fed's fund rates are. So they're almost kind of like a type of option per se. But recently we started to see a sharp rise in the 10-year Treasury yields. Typically when we see a rise in the 10-year Treasury yields, that's usually caused by inflationary fear. And this is because investors are starting to pull money out of bonds and put it into the stock market. Typically when people sell bonds, that creates downward pricing pressure on bonds, kind of almost like it does with stocks. But then when bond prices fall, Treasury yields rise. The reason for that is to attract more investors to bonds with higher yields. But the main reason why we're seeing this transition out of bonds is actually because of the news that we got on Tuesday. News came out that the Fed is currently discussing how to offload about the $9 trillion worth of bonds that they currently hold. And the technical term for this is shrinking the Fed's balance sheet. There's discussion about either selling off the bonds that they have over time or letting them reach maturity. And given that the market doesn't think that the Fed will be able to raise rates 3 times this year, the Federal Reserve is looking at possibly selling bonds as another way of taking money out of the economy. And in turn, another way to slowly raise rates. Typically, when you raise rates by selling bonds, it actually is a more gradual uptick versus just raising rates, even if it's just 0.25%. On Tuesday, we also got the PMI report, which is the Producers Manager Index report. In that report, we saw that the index has actually hit an inflection point and is starting to trend downwards, which is a sign that we may have hit an inflection point in the inflation trend. Even though a lot of the bond activity that we're seeing does show that the market is anticipating inflation, a lot of the activity is skewed mostly because of what people believe the Fed will do with the bond market, which is they'll start selling off the bonds that they have and start introducing more bonds into the market. So a lot of people in the market want to get out of bonds before that selling pressure comes. So basically when it comes to value stocks or recovery stocks, we're going to start seeing a lot of the money from bonds flow into these stocks, as a lot of these stocks are seen as safe havens to invest in at the moment. So I think for the next couple months or so, we're going to see a pretty significant uptick in value stocks. But when it comes to the high PE and tech stocks out there, since bond yields are rising, a lot of the institutional investors like to take money out of the high valuation companies, and in turn, these companies will sell off. So if you're an investor in tech stocks, this can make for a really good opportunity for you to build out your position a little bit longer. That's pretty much all I got for you guys today. If this video provided you with any value, please consider hitting the like and subscribe button. They both greatly help out the channel, help push this video out to as many people as possible. Like I said, I was checking my analytics and about 85% of you guys are not subscribed. So if you made it this far through the video, you should probably hit the subscribe button. Also, let me know what you guys think in the comment section down below. I'd love to hear from you guys. Check me out on all my social medias. I try to post there every day. And thank you so much for watching. I'll see you in the next video.